Welcome to Drill Down Earnings. I'm Cory Johnson, Chief Market Strategist for the Futurum Group. Veeva earnings Q1. Veeva Las Vegas, because you might have better luck making money in Vegas than you do on this stock. I've got the business story behind this stock on the move. The stock's moving down. Why? Well, let's talk about the results we just got from this company. Wall Street likes a beat or a miss, and this was a beat. The quarter was pretty good, but the guidance was pretty bad. So let's talk first about the quarter. Total revenues, $650 million. Subscription revenues of $534 million, really good, up 29% year over year. Revenues growing at 24% year over year. But the guidance just wasn't that great. As we look forward, they say they're going to take the growth of about, 10% of the most recent quarter of total year-over-year growth in revenues, and that's going to fall, and it has been falling for the last few quarters on a quarterly basis here, 24% as I mentioned, and that's going to fall to 13%, which just isn't good. Their non-GAAP operating income, which is strip out stock compensation and stuff like that, because the top line's not growing a lot, the bottom line's not going to grow a lot, even though margins might hold tight, and their billings. Even if you look at an annual basis, their billings growth really coming down, so down to 10% on an annual basis for this company. What's also interesting, and this may have been overlooked, they announced a big accounting change. What they said is that their customers, so Veeva makes kind of a Salesforce-like software as a service for the biotech industry, particularly around biotech and pharma trials and managing those trials. And so what they noticed in the past, their customers would kind of sign on for 1 year. They said that's changing. Customers are signing on for many years. But because of that, they have a right to terminate the contract. It wasn't a big deal when they were 1-year clients, but 3-year clients, if they terminate after a second year, Veeva has to account for that risk. So they can only bill a certain amount to a 3-year deal. So in the beginning of that billing, they have to bill a little bit. The middle year, they can bill more. The third year, they can bill a lot. So it's not a straight line of revenue recognition. And the result of that change in what's called TFC, or termination for convenience, means they have to instill that right, if you will, into their accounting treatment. It means they're going to recognize less revenues from new deals in the first year of that deal, and that's going to hurt their revenue growth and their bookings growth as they add new business. Well, Wall Street wasn't ready for that. So the stock, when they announced their guidance, just collapsed. Stock down 11% in after-hours trading, and that's after growing 19% for the last year. So underperforming the S&P 500 for the last year, and now dramatically falling as the effect of these previously announced accounting changes really hit the numbers. Now, it was interesting in the conference call to hear Veeva CEO Peter Gassner talk about the ways that they're changing their software and changing their business to use AI and to try to have, a shocker, AI again, to have AI in their actual business. And they've been writing ways to clean up the data that their customers are creating so that it's ready to be used for AI. They think that's good for their long-term growth. Here's Peter Gassner.
Innovation has to come from everywhere. And one of the things it needs is clean data. All these AI applications need clean, concurrent, fast data. So one of the things we started about 2 years ago, actually, is put in a new API on the Vault platform called the Direct Data API. And that was just released this April, and that provides concurrent, consistent data about 100 times faster than normal APIs. So I think that's going to be a great thing. Now, when we look to the long term, some of those applications will be developed by our customers, some by partners, and over time, probably some by Veeva as well. But we're concentrating on the foundation for the APIs for the data, the core system, because that's really only Veeva that can deliver that for our customers.
So yeah, preparing clean data so that their customers can use AI however they want to do so. Seems kind of smart to me, but it's going to take a while to unfold. All right, what's it all mean? What's one number to take away from these results from Veeva? I'm going to have that drill down bite right after this.
The drill down is brought to you by Futurum Group, where analysts, researchers, advisors, content creators, and marketing experts help business leaders anticipate and understand shifts in their industries and build strategies to leverage disruptive innovation. With deep analysis, Futurum Group's extensive industry experience delivers reliable research and data, thought leadership, and actionable advice to help you with your strategy and go-to-market efforts. Futurum Group.
So here's what I want you to know about Veeva's Q1 earnings. It's a pretty good quarter, $650 million in revenues. On a year-over-year basis, overall revenues increasing by 24%. but the company warning that numbers are going to get worse for them, and that indeed that this business is going to grow a lot slower. Some of it because of an accounting change, some of it because their customers are just finding other ways to spend money. They insist they're keeping market share, but the drill down earnings bite shows you that their billings growth is now going to be growing at just 10%. That's the number to remember, 10%. All right, thanks for listening to Drill Down Earnings. I'm Cory Johnson. Check me out on X at CoryTV, Drill Down Pod on Instagram and TikTok, and of course, the fabulous YouTube page for Futurum Group. Check it out. Drill Down Earnings, part of 6.5 Media.